Welcome to Goldbank Insider. Today we are looking at the London-listed precious metals giant, Fresnillo. Now, usually when we talk about the big miners on the FTSE, we're dissecting drill results, looking at head grades, or maybe talking about production guidance. But today we need to talk about the plumbing.
The financial architecture. It's not the glamour of the geology, but it is often where the real strategy gets revealed.
Exactly. We're looking at a specific update regarding the Coneto Silver Gold Project. This is a restructuring move involving Fresnillo and a couple of partners. And look, let's be honest right out of the gate. This isn't the kind of news that causes the share price to spike 10% before lunch.
Yeah, no, absolutely not. It's a technical adjustment. But for those tracking the sector, especially from a UK perspective, these are the moves that tell you how a management team is actually thinking about risk.
Right.
It's about how they hold their assets, not just what assets they hold.
So the mission here is to take apart this restructuring of the Coneto project. We want to understand why Fresnillo is moving the furniture around, because this isn't just about rocks in the ground anymore. It's about the vehicle used to access the value of those rocks.
Precisely. And we should stay grounded here. We aren't going to hype this up as some massive pivot. It's a calculated portfolio-level decision. But for the astute investor, these adjustments are a window into the boardroom's logic.
Okay, so let's get into the mechanics of the transaction. We have Fresnillo, obviously. Who else is at the table?
You have Orex minerals and Silver Viper minerals involved. The core of the update is that Fresnillo is altering its interest in the Coneto Silver Gold Project.
I was looking at the original structure, and it was a fairly standard setup, right? Fresnillo held a direct project stake.
Correct. Previously, they held a direct interest. Think of that as owning a slice of the actual operation. You're a partner in the joint venture at the project level.
It's tangible.
Very tangible. You own a percentage of the license, the liabilities, and the potential production.
And the after picture, what does that look like?
Well, the mechanism has shifted. Fresnillo is swapping that direct exposure for a compelling alternative. They're moving into an equity position.
An equity position.
Yes. As part of this transaction, Fresnillo is receiving shares in Silver Viper minerals.
So they're swapping a hard asset, a literal percentage of the joint venture, for paper, equity in Silver Viper.
That's the essence of it.
My immediate question is, why give up that control? Usually a major miner wants to control the timeline. I decide when we drill. I decide when we build. By taking shares, aren't they sitting in the passenger seat?
That is the trade-off.
Yeah.
It's a very good point. But look at the cost of being in the driver's seat.
Okay.
If you stay in the direct joint venture, you're on the hook for capital contributions. You have overhead. You have management distraction.
Right, your team's got to fly out there, attend meetings.
Exactly. By converting to equity in Silver Viper, Fresnillo effectively says, we still believe in the geology, but we don't want to run the camp.
So it's a capital allocation play.
It is about efficiency. The shares they're receiving are linked to their interest in Coneto. But the form of ownership changes the obligation completely.
I want to push on that distinction because I think it's critical for anyone holding the stock. What is the material difference between holding the project stake versus holding the stock of the company running the project?
It comes down to asset viscosity.
Viscosity, I like that. Explain.
How easily can you move the asset?
Mm-hmm.
When you hold a percentage of a mine or a project, that is an incredibly illiquid asset. It's sticky.
Mm-hmm.
You can't just wake up one morning and decide to sell, say, 0.5% of your joint venture interest because you want to raise a little cash or rebalance the portfolio.
No, there are contracts.
Contracts, partner approvals, rights of first refusal. It's heavy lifting.
Right. It's like trying to sell a single room in a shared office building. You can't just list it on an app.
That's a perfect analogy.
Yeah.
Exactly. But equity, shares in a listed company like Silver Viper Minerals, that is a different beast entirely.
So that brings us to liquidity.
That brings us to liquidity.
Assuming there's volume, of course.
Touché. A very fair point. Assuming there is volume. But even with thin volume, listed shares are generally easier to value day to day.
You can just look it up.
You can look up a ticker symbol and see exactly what the market thinks that holding is worth at any given second. A static project stake is opaque. It sits on the books at a historic value until someone writes it down or sells it.
So presumably, if Fresnillo wants to adjust its exposure later, say, the silver price goes on a run and they want to cash out some game-selling shares on the open market, is vastly simpler than renegotiating a joint venture contract.
Vastly simpler. It reduces friction. It makes the asset more manageable from a pure portfolio perspective.
Okay, but there is no such thing as a free lunch. We know that. What is the new risk they're taking on? Because there's always a new risk.
They're accepting the equity risk premium of the junior partner.
Okay, unpack that.
Well, when you hold the project directly, your risk is mostly technical. Is the grade good? Is the rock competent? Can we get the permits?
The rocks and the drills.
The rocks and the drills. And now, by holding shares in Silver Viper Minerals, Fresnillo's upside is now directly tied to Silver Viper's share price performance.
So they've introduced market risk into the equation.
Correct. A whole new layer of it. You could have great results at the Coneto project, fantastic drill cores, everyone's happy. But if Silver Viper has management issues, or if the market sentiment turns against that specific company for whatever reason, or if they dilute shareholders to raise capital for a different project entirely,
Fresnillo's holding suffers.
it suffers, even if the asset in the ground is performing beautifully.
That is a crucial point. The asset in the ground could be performing, but the stock could be stalling or going in reverse.
They have coupled their asset value to the broader performance and sentiment surrounding Silver Viper Minerals. That is the price you pay for that added liquidity and flexibility.
Let's zoom out to the mothership then. We need to context this deal within the broader picture of Fresnillo itself. Where does the company stand right now in the eyes of the UK investor?
Well, looking at the current snapshot, Fresnillo shares have been trading around £35.56.
Which, let's be honest, is a hefty price tag. I was looking at the multiples this morning and my eyes watered a bit. We are priced for absolute perfection here.
It is the scarcity problem, isn't it? If you're a UK fund manager and you have a mandate to hold precious metals exposure, what do you buy?
There aren't many options on the FTSE.
Very few of this scale. You can't always buy the physically backed ETFs in some mandates. You don't want the geopolitical risk of some of the strictly African miners, so everyone piles into Fresnillo.
So it creates this kind of artificial floor under the price.
It creates a London premium. That's what I call it. They traded a massive multiple expansion compared to their peers in Toronto or New York. The PE, the price to earnings multiple, is high compared to broader market benchmarks.
So investors are willing to pay up sometimes 30, 40 times earnings because it's the only game in town for institutional capital in the UK wanting that kind of leverage to silver.
Exactly. But that makes them fragile.
Fragile how?
When you are trading at those levels, a restructuring deal like Coneto isn't just housekeeping. It is scrutinized. The market asks, are they running out of organic growth? Is that why they are shuffling papers instead of pouring concrete?
That's the fear, right? That they're becoming an investment holding company rather than a true miner because the big company making discoveries are just drying up.
It's a valid concern. It really is. However, you can flip that argument completely.
Go on.
You could say this deal actually supports the investment thesis because it keeps the pipeline alive without the upfront cost and risk.
How so?
Well, if you're buying Fresnillo at 35 hours, you're buying into their long-term silver and gold pipelines. That's the story. This deal provides another route for Fresnillo to participate in exploration progress at Coneto without carrying the direct operational weight.
So they get the upside without the capex?
Or at least with deferred capex. It allows them to keep a hand in the pot, maintaining that pipeline narrative, but doing so via a financial instrument rather than heavy operational involvement.
It effectively optimizes their portfolio, a bit like pruning a tree to make it stronger.
It does. It shows they're actively managing their assets, not just sitting on them. And at this valuation, the market wants to see active management.
Okay. So, for the investor listening to this who holds Fresnillo or is thinking about it, what goes on the checklist? What do we need to watch next coming out of this?
I think there are three key signals to monitor here. First, obviously, is the Silver Viper Minerals pricing.
Because Fresnillo now owns a chunk of them. Their fortunes are linked.
Exactly. Since Fresnillo's asset value regarding Coneto is now partly tied to this equity, you need to track Silver Viper's chart. If Silver Viper tanks, that part of Fresnillo's portfolio takes a hit. It's that simple.
Okay, that's number one. What's number two?
Coneto project updates. We can't lose sight of the fundamentals.
The rocks.
Always back to the rocks. The driver of value is still the success of the exploration at Coneto. If they find nothing, the shares in Silver Viper lose value, and the stake loses value. The geology still dictates the ultimate reality.
And the third signal?
Fresnillo's own volatility. Given that stretched valuation we discussed, you need to keep a very close eye on how the market reacts to minor news.
Because it's sensitive.
Highly sensitive. When a stock is this expensive, any news flow can have an outsized impact. The market's expectations are just so high.
So synthesizing this view for our UK investors, what is the lens we should use to look at this specific news item?
The lens is that the structure of the deal is just as vital as the asset itself. This move changes how risk and upside show up in the Fresnillo share price. It's not just about rocks, it's about the financial wrapper around those rocks.
Right, let's wrap this up. To recap, Fresnillo has swapped a direct stake in the Coneto project for shares in Silver Vipe Minerals.
The gain for them is flexibility and liquidity. They have made the asset easier to handle, easier to value.
And this is all happening against a backdrop of a high valuation share price, around £35.56, where the market is watching every single move very closely.
Correct. The context is everything here.
Okay, here's a thought to leave you with. We often think of miners as industrial operators, guys with hard hats and excavators. But when you look at a deal like this, you have to ask yourself, how much of a major miner's value is actually derived from their operational efficiency versus their skill in portfolio management of smaller exploration companies?
That is the question, isn't it? In this case, Fresnillo is acting almost like a fund manager for this specific asset.
Right?
They're allocating capital into equities rather than pouring concrete. It really blurs the line between miner and investor.
Something to mull over as you watch the tickers. That is it for us on Goldbank Insider. Thanks for listening.